Hello everyone, welcome to the Homebuyer webinar, and today we're talking about the differences between FHA, VA, conventional, and USDA types of financing. Now, chances are, if you're a home buyer and you're beginning to talk to lenders about your home loan, you're going to land in one of these four options. So let's take a look at what they are. FHA. FHA stands for the Federal Housing Administration, and it's been around since 1934. VA, which is overseen by the U.S. Department of Veterans Affairs, oversees everything to do with veterans. Conventional is overseen by Fannie Mae and Freddie Mac, and we'll explain shortly what those are. And USDA, which is overseen by the U.S. Department of Agriculture. Now, before we can really understand these different types of loans, we need to take a step back and get an understanding of how, historically, home loans have been provided and sustained in this country. Now, when a loan is funded, the investment made by that bank is backed by an investor. Now, this means that rather than having to wait 30 years to get the original principal balance and the interest back, the bank can make some immediate money by selling the right to collect those interest payments to an investor, and that investor is in it for the long haul. Now, in other words, another investor comes in, buys the debt, and the right to collect payments on it. Now, why is this important? It's important because the local bank or mortgage company or credit union can make their money back immediately and return to the business of helping the next home buyer without tying up their money for 15 to 30 years, which is an awful long time. Now, how do banks get their money back immediately? And how do they continue to provide loans? Now, historically, what the banks did was reach out to a middleman that bought these loans, thousands upon thousands of them, good loans, bad loans, all mixed up together, and then they played the role of finding investors for these loans all across the world. Now, imagine these mortgage loans as red apples, green apples, yellow apples, bad apples, good apples, old apples, organic apples, all mixed up in one bag, and the middleman takes that bag and slices it up in little bags, small groups of loans, and sells them to end investors all over the world. Now, the middleman, by playing that role, enables both the big and small banks to keep lending money because there's always a constant supply of cash to come and replenish the money that they've lent out. Now, in the U.S., historically, there have been three major companies that played that middleman role, or they backed private companies that played the role: Fannie Mae, Freddie Mac, and Ginnie Mae. Now, let's talk about the last one first, Ginnie Mae. Ginnie Mae stands for Government National Mortgage Association. It's actually a government agency within HUD. Now, Ginnie Mae backs certain types of mortgages that are bought and sold all over the world. The end investor who buys the loans, whether they're a pension fund in Germany or an insurance company in China, for example, those end investors carry less risk because the full faith and credit of the U.S. government is behind these loans that are bought and sold. Now, essentially, the U.S. government is guaranteeing the monthly payments to the holder of that bag of apples, the pool of mortgages. Now, what does this mean on the street? How does this affect the home buyer qualifying for a mortgage? Get this, loans backed by Ginnie Mae carry more flexible underwriting guidelines and lower interest rates or better pricing, and we'll explain to you here in just a little bit why. Now, unlike Ginnie Mae, Fannie Mae and Freddie Mac, the other two companies that are playing that role, that middleman role of buying and selling mortgages in bulk, they have government oversight and often even government intervention, like we've seen in 2011, 2010, but they are not actual government agencies. The loans that they buy and sell across the world are not 100% backed by the U.S. government, and so their standards and their guidelines are tighter. Now, which loans are backed by Ginnie Mae and which are not? In other words, for which loans does our federal government come in and provide a guarantee to the end investors saying, hey, if payments stop coming in, we will step in and make good? Which are those loans? The answer, FHA, VA, and USDA. And this makes those mortgages less risky to the end investors, which in turn means lower pricing on the street, better and easier qualifying for the borrower, for the home buyer on the street. Now, Fannie Mae and Freddie Mac overseen loans are considered conventional. Now, in 2011 and 2010, I don't want to go off on a tangent here, the government actually announced that Fannie and Freddie will gradually be, phased out or wound down. And this is going to leave our economy depending on other sources to play that role of providing mortgage money to the banks by packaging those pools of mortgages and selling them off to investors all over the world. Okay, let's take a look at FHA. As we've already said, because the lender has the full backing and guarantee of the U.S. government behind the loan, they can tolerate more risk and allow lower down payments when considering FHA financing. Now, there's different types of FHA mortgages, but the most common is the FHA 203B, which has a 30-year and a 15-year fixed loan option. Now, let's look at the pros and the cons of FHA financing, folks. Pros: lower down payments as low as 3.5%, allowing for 96.5% financing. Flexible and forgiving underwriting standards, including 2 years from a bankruptcy discharge and 3 years from a foreclosure. FHA allows for non-occupant co-borrowers. In other words, typically family members can come in and co-sign for a borrower without even intending to live in the property. And what FHA allows is for the lender to blend the total income of all the borrowers and on the total debt of all the borrowers. And in doing so, the strength of the non-occupant borrower can even out the weaknesses of the occupant borrower. Now, less credit depth is still acceptable. And it's not always necessary to have a high FICO score. In fact, FHA loans can be made to borrowers who have no traditional credit, such as, credit cards, student loans, and auto loans, and so on and so forth. FHA loans can be made to borrowers that have non-traditional credit, such as utilities, rent history, car insurance, cell phone subscription, so on and so forth. Now, FHA allows the seller to give up closing cost concessions up to 6%, even at the highest loan-to-value of 96.5%. And we'll see in a little bit how that's unique. The entire down payment from the buyer can be gifted. This is in stark contrast to conventional loans, where typically at least the first 5% of the down payment has to come from the buyer's own funds. Now, with FHA, certain debts, if they're deferred, can be taken out, eliminated from the monthly payment obligations, such as, for example, student loans. FHA has a streamlined feature whereby after 6 timely payments, if the market rates have dropped, the FHA loan can be refinanced without an appraisal and with very lean credit qualifying to a lower interest rate. It's very attractive. It's a way for borrowers to get in with an FHA program, and if the rates improve, if the market improves, they can take advantage of that, drop their monthly payment without having to go through a full-blown refinance. Finally, when we're talking about pros of FHA financing, FHA loans don't require any cash reserves in the bank. Even $1 over what's needed for down payment and closing costs to close the transaction is perfectly acceptable. Cons: let's look at some of the negatives. FHA can involve the appraiser being a little bit pickier on the condition of the property. Now, there are restrictions on buying homes that are being quickly resold for profit. In fact, we have a whole other video home buy webinar tutorial on FHA flips where the seller has not owned the property for 90 days. The seller's reselling the property for profit within 90 days of acquiring it, and you want to take a look at the details there. Mortgage insurance on FHA loans continues for a minimum of 5 years, even on a 30-year term. And there's an upfront mortgage insurance and an annual mortgage insurance. Now, in the 9 community property states, Arizona, California, Nevada, Idaho, Louisiana, New Mexico, Texas, Washington, and Wisconsin, the spouse's debts have to be considered, which can often lower the amount an individual can qualify for. So even if you're borrowing and your spouse is not going to borrow on the loan, she's not going to sign, or he's not going to sign on the note, his or her debts, monthly payments have to be counted against you, and that can lower your buying power possibly. Now, the loan limits set for the counties involving FHA financing are typically lower than what's set by Fannie Mae and Freddie Mac in those same counties for conventional loans. Now, for example, up until recently, the max loan amount for conventional was $417,000 in many areas of the country. FHA cannot be used to finance investment properties or second homes. Let's talk about conventional, folks. Conventional interest rates tend to be a little bit higher because even though, as we said before, a government-sponsored enterprise, i.e. Fannie or Freddie, backs and buys these loans, it's technically not the government that's guaranteeing them. Therefore, there's a little bit more risk to the investor, which is reflected in the interest rate pricing adjustments. For example, there are adjustments to the interest rate for things like loan to value. For example, an 85% loan to value would have a higher interest rate more than likely than an 80%. Size of loan, in other words, the loan amount, the FICO score. Higher FICO scores have better pricing than lower FICO scores. Occupancy status. A loan requested to purchase a home as a vacation or a second home is going to have a little bit worse pricing than an owner-occupying property pricing. And of course, the property type has an effect on the pricing as well when we're talking conventional. Now, let's look at the pros and cons of conventional financing. Pros: there are less rigorous property appraisal requirements. There's no upfront mortgage insurance. There are higher loan amounts typically. And here's a really good one: the spouse's debts do not have to be counted against the borrower when qualifying. So if your spouse, your significant other, has monthly debts that are not reflected on your credit report, that does not have to lower your buying power. And finally, there's no mortgage insurance if you're borrowing 80% or below. And that's in comparison to FHA, where with FHA, even at 80% loan to value, you have mortgage insurance for the first 5 years. Okay, let's look at the cons or the disadvantages of conventional financing. Typically, longer waiting times since derogatory events such as bankruptcy, foreclosure, short sale, deed in lieu of foreclosure, so on and so forth. Stricter credit requirements and tougher underwriting rules. Typically, borrowers that go for conventional financing have to have pretty good credit history and high credit scores. Private mortgage insurance, also known as PMI, is not automatic with conventional financing. Now, there are various PMI companies such as Genworth, MGIC, Radian, and so on and so forth. And once the conventional underwriter at the mortgage company has approved the file, the PMI company itself has to underwrite the file according to their standards before the mortgage insurance certificate can be issued. So it's not always automatic. And there are instances where the loan will get approved by the underwriter and the PMI company can't issue the mortgage insurance certificate, and you pretty much have a dead deal. Another con is that non-occupant co-borrowers are not allowed on owner-occupied transactions, this is different to FHA, as we discussed. Borrowers with no scores and no traditional credit cannot be approved typically, and they may have to resort to special conventional programs, kind of niche programs that carry higher interest rates, such as My Community. There's less of a tolerance for high debt ratios. In fact, the automated system that Fannie Mae uses, known as DU, that you might have heard about, has become tighter and tighter over the years, where higher debt ratios that used to pass through are now getting stopped at the door. And typically, you're going to have a debt ratio of 45% or less to be able to get through on a conventional loan. Now, until the loan to value drops to 80%, the seller can only contribute 3% of the purchase price towards the closing costs. Let's take a look at VA. VA loans are for those who have or are presently serving in the armed forces of the U.S. If discharged, that discharge must be something other than dishonorable, as shown on the DD-214 separation papers for the veteran. The Department of VA actually gives the lender a guarantee up to 25% of the loan amount. So this usually means if the home would have foreclosed and the lender ended up selling it at 75% of value, it would still make out okay because it would recover the other 25% directly from the VA. Now, in order to obtain a loan guaranteed by the Department of VA, the veteran must provide what's called a COE. If you take a look at your screen, also known as a certificate of eligibility, it looks something like this. Now, the COE is something your lender actually can get for you through the internet, through online, as long as you provide the pertinent data. The COE, the certificate of eligibility, actually shows the entitlement amount that is relevant to that veteran, and then there's a magic formula that takes that entitlement and turns it into a maximum loan amount in that county for that veteran. Up to 100% financing. For example, recently in California, most counties had at least $417,000 max loan amount, and some counties had as high as $625,000. And up north in Northern California, some of the more affluent counties, if you would, the veteran could borrow up to $1 million with no money down. Pretty amazing. Now, the VA helps cover the administrative cost of the program by charging a one-time upfront VA funding fee. For the first-time veteran user, this was recently 2.15% of the loan amount, and for repeat users, as high as 3.3%. Now, let's talk about the pros and cons of VA financing. Pros. Because, just like FHA, VA loans are ultimately backed by none other than the U.S. government, Ginnie Mae. The rates tend to be lower, and riskier credit profiles are accepted. Now, veterans with bankruptcies as recent as 2 years and even foreclosures as recent as 2 years old can be eligible for VA financing. They can borrow 100% of the purchase price. The seller can pay not only 4% towards the customary closing costs, but check this out, folks, but also another 4% towards concessions such as paying off the veteran's debts to enable him or her to qualify. Pretty amazing. In other words, the seller can assist in paying off the veteran's credit card debt, for example, to help that veteran qualify. So if you add 4 and 4 together, that's a total of 8% of the purchase price in seller concessions that can be given up. Very attractive for veterans to get into the home with VA financing. No cash reserves are needed. The VA can be funded for widows of deceased veterans who never remarried. Veterans without credit scores or traditional credit can be eligible as well, just like with FHA, as we discussed earlier. There is no mortgage insurance, even at 100% financing. This makes it very attractive. No MI, there's no upfront MI, and there's no annual MI for VA financing. And finally, veterans with service-related disabilities, 10% disability, can have their VA funding fee waived if they can document that, and that means they end up borrowing exactly 100% of the purchase price and nothing more. Cons. What are some of the negatives with regard to VA financing? Only veterans or their spouses can be on the loan. No one else. You can't have a girlfriend, boyfriend, a family member, and you certainly can't have a non-occupant co-borrower, whereas you can with FHA. Now, in the community property states, the spouse's debts, just like with FHA loans we mentioned earlier, has to be counted and can lower the buying power. The property is rigorously inspected by the VA appraiser. In fact, some sellers tend to react unfavorably because of the stigma associated with VA loans for that reason. And it takes a good skilled loan officer to get on the horn, get on the phone with the seller and or the seller's agent and reassure them regarding VA financing, because quite honestly, it's really not that bad. And a lot of the VA loans that we've been involved with have closed smoothly and quicker than even FHA or conventional financing. And finally, obviously, you have to be a veteran, in active duty or reserves or National Guard to be able to get a VA loan. It's not for everyone. Finally, USDA loans. Let's talk about USDA loans. USDA loans are guaranteed by the U.S. Department of Agriculture, and they give the lender assurance that they will guarantee up to 90% of the amount of the loan in the event of default. Now, in response to this guarantee by the USDA, lenders will lend 100% of the purchase price and sometimes even more than 100% of the purchase price if the appraisal supports a higher value than the contract price between buyer and seller. Pretty amazing. And this makes the USDA loan unique amongst the big four loans. Let's take a look at some of the pros of USDA financing. 100% financing, no money down. Flexible underwriting guidelines such as FHA. There is no loan amount limit. I don't think you heard that. There is no limit on the loan amount. That's an awesome thing and stands that apart from FHA and conventional financing. There's no limit on the loan amount. The borrower is only limited by how much they can afford. There is no cash reserves needed. The seller can pay an unlimited amount in closing costs unless the amount being paid is abnormal for the area or for the market the home's in. But again, it's not uncommon for USDA financing to involve, 7 or 8% seller concessions. Lower credit scores, typically 620 or sometimes even lower than that, are accepted by lenders for USDA financing, and even buyers with no score and no traditional credit can be approved. Now, here's a good one. Repairs can be financed in with the USDA purchase loan up to $10,000. Now, this enables a buyer to purchase a home that needs a little bit of renovation without having to come up with their own cash. Incredible thing. So $10,000 is funded on top of the loan, and those funds are held in escrow or an escrow account for the work to be completed, typically within 30 days of closing. Now, income from a second job can be used when you're doing USDA financing, used for qualifying purposes, even if there's a one-year history of it, which is pretty special compared to FHA or conventional. So if you've got a second job and you've got documentable income from it, on a USDA loan, you can use that income with only a one-year history. And the last thing here we're going to talk about under the category of pros is the mortgage insurance that's now imposed on USDA loans as of October 2011 is to be declining with each passing year as the loan principal balance goes down. Now, that's unique compared to FHA mortgage insurance. The USDA mortgage insurance, which is 0.3% per year, the dollar amount is going to decline because it's always based on the principal balance of the loan in that year. Cons, negatives of USDA financing. Obviously, only owner-occupied properties are eligible. Non-occupant co-borrowers are not allowed. There are income limitations based on the number of persons in the household and the county that the property is being purchased in. And be sure to look at some of our other more detailed USDA homebuyer webinars available on the blog and the YouTube channel to get the nitty-gritty details on that. But there are income limitations. There are also geographic restrictions. So only properties in eligible areas can be financed. Again, check our YouTube channel and our blog to understand how to read the USDA eligibility map and how to find out which areas are eligible and which are not. I should say this, all 50 states have eligible areas for the USDA loan. Now, after the initial underwrite by the lender, the USDA field office has to do a second brief mini underwrite of the file before the conditional commitment can be issued. And that's what allows the file to go through the closing. Now, sometimes, and not always, this can result in slight delays and longer processing times, and you should be aware of that. Now, unlike conventional loans, in community property states, the spouse's debts need to be counted against the borrower, just like FHA and VA loans. Bankruptcies need to be 3 years old whereas FHA and VA allow 2 years cooling off period from a bankruptcy. Thanks for watching, folks. I hope you found this video webinar tutorial helpful. There are several other homebuyer webinars available on the blog and the YouTube channel. If you have any questions, feel free to call us at the number on the screen or email us, and thank you again.